Our subject today is the economics of inflation, and I guess that really means simply what are the most important points to realize in connection with inflation. And let me begin by trying to show that the quantity theory of money is the only possible valid explanation of any sustained, significant general increase in prices. Now, we're starting off with the phenomenon of generally rising prices. That's the object of our inquiry, at least initially. Most people define inflation as rising prices. I think that's a profound mistake. But we can begin with an attempt to explain rising prices, and I think any serious systematic attempt to do that will reach the conclusion that the only possible explanation of a sustained significant rise in prices that at the same time is consistent with other leading symptoms that people ascribe to inflation, the only possible explanation is an increase in the quantity of money. And once we've reached that conclusion, thereafter we should proceed to think of inflation not in terms of rising prices, which is merely one of its leading consequences, but we should think of inflation in terms of an increase in the quantity of money. And I'm out to show that it's an increase in the quantity of money which is responsible for rising prices. If you were in the money and banking seminar I shared yesterday with Professor Salerno, I gave a simplified presentation of the quantity theory of money. The basic idea is the amount of money that is spent is determined primarily by the amount of money that exists. The larger the quantity of money in existence, the larger the volume of spending. You might imagine an old gold miner stumbles upon a gold deposit back in the days when gold was money. The gold is then minted into coins. That's how money came into existence at that time, first by digging gold out of the ground, then alloying it and actually physically manufacturing new and additional coins. The owner of those coins will spend them. The people who receive them in turn will respend them, and the new and additional money will be spent and respent ad infinitum, making the level of spending higher than it otherwise would have been so long as the additional money is in existence. And it's essentially that phenomenon which serves to explain rising prices. We can conceive of the general consumer price level, or the price of anything. Let's start with something as simple as possible, the price of a bottle of water such as this. And think of the nearest store which sells such bottles of water, and imagine you had the assignment, you wanted to know what was the average price at which a bottle of this water sold for in that store over the last week. What information would you need to know? You'd have to know how much money was spent in buying such bottles of water and how many units were sold. So if people went into the store and spent $100 for bottles of water over the week and walked out with 100 bottles of water, then we'd know the average price at which a bottle of water was sold in that store for that week was $1 per bottle. Now, what would be mathematically necessary in order for the following week for the price of a bottle of water, the average price at which a bottle would be sold in the following week, to be higher, let's say $2 a bottle? What would be mathematically necessary to have an average price of $2 a bottle instead of $1 a bottle? Well, either more money would have to be spent buying the same 100 bottles. If $200 were spent to buy 100 bottles, that would certainly do it. Or if alternatively 50 bottles were sold for $100, that would do it. Is there any third conceivable answer as to how the weighted average of a price at which something is sold, how the average price at which something is sold could be higher, other than more money is spent to buy it or less of it is sold? Can you think of a third possible explanation? Yes?
Seeking out alternative products?
Well, suppose someone sought alternative products, how would that affect the price of this product? It could show up as less money being spent to buy it, right? Now, suppose someone alleges something is a cause of a higher price, but you cannot connect that alleged cause either to more spending or to less supply being sold. Suppose I allege alternative products, whatever, or taxes, or command from Zeus. I allege something is responsible for raising the average price at which such a bottle is sold, but I cannot in any way show how it makes the amount of money spent to buy it more than $100 or the quantity being sold less than 100 units. Would I have any basis of explaining how the price could be higher? It is literally unthinkable. It's comparable to trying to think of a square circle or a liquid solid. They're logically irreconcilable ideas. The only conceivable way that the price of any individual good can rise from the point of view of the laws of arithmetic is there must be either more spending to buy a given quantity or less of a quantity sold for a given amount of spending, or some combination of the two. Now that applies to each and every good. We could obviously substitute for bottles of water, bottles of soda, packs of cigarettes, boxes of detergent. We could go to automobile dealers, substitute automobiles, anything. Now, in the entire economic system, we can think of the totality of spending for all the consumer's goods and services combined over a given year. Now, we have a problem because our supply then is not going to be one simple homogeneous good like bottles of water. We'll have to be thinking of bottles of water, bunches of carrots, automobiles, houses, computers. We'll be thinking of a whole enormous array of goods. And there can be certain great difficulties in attempting to add this up. But I think every day all of us do make judgments about the total supply of goods in a country. I think without question we could say that the total physical output of the economy of the United States today is substantially larger than it was 50 years ago. Or the total output of the economy of the United States today is substantially larger than the output of the Canadian economy. So we do make such judgments. Now, as a matter of empirical practice, if we were going to say, well, would you say that the overall quantity today is 9.3 times larger or 2.78 times larger? We could have infinite argument about that. But what is essential is we do recognize that the overall supplies are greater or lesser in one way or another. We are adding up, in a rough sense, the totality of automobiles, computers, television sets, and so forth. And now all we have to do is realize that however we might express it, that there is only one way for the weighted average of the prices of things that are sold to rise. If we do recognize that we can think of the overall total output as more or less, and for purposes of thought we can attach some definite quantity. We'll say, we'll call this X, and we'll call the quantity at a later time 2X, or whatever. There are only two thinkable ways that the weighted average at which the prices of goods and services actually sold can rise. And that is if there's more spending to buy the output or there's less output. No other way is thinkable. The only way that the weighted average of prices at which goods are sold goes up is if there's more money spent to buy them or a smaller quantity being sold. Now, what do we know very definitely has happened to the quantity of goods and services being sold? Maybe not this month compared with last month or 6 months ago, but today compared with 5 years ago, or certainly 10 years ago. It's been going up. So as far as supply is an issue, there's more goods and services being offered. And if we had had the same amount of spending, what should have happened to prices? They should have been going down. Now, the fact that prices have been rising over the same period of time in which supply has been increasing means that what is the only possible mathematical explanation of the general rise in prices? Yeah, more spending, more spending. And the foundation of the additional spending is the additional quantity of money. That's why prices are rising. Now, I think it's easy to show that while it's true that less supply could raise prices, if you think about the implications, in order for less supply to be responsible for a relatively modest rise in prices, let's say on the order of just 2%, if we were to judge that prices over the course of 2003 are 2% higher than over the course of 2002, and if the explanation were to be less supply, how much less supply would be mathematically implied? 2% less. Supply should be approximately 98% this year of what it was last year, whatever the number would be, such that when we divided it into 1, the result would be 1.02. Now, so we could conceivably have a rise in prices based on less supply, but what would be the implications of attempting to explain a 2% compound annual rise in prices over a sustained period of time? Like, how long does it take for prices rising at a 2% compound annual rate for prices to double?
12 years?
Well, it's 35 years. 35 years. Okay, now, if we observe that over the course of 35 years prices double, if falling supply were to be the explanation, what would have had to happen to supply over that 35-year period? Yes? It would have to have been halved. So in order for falling supply to be the explanation of a doubling of prices, we'd have to find a halving of supply. And if we were to have a 2% compound annual rise in prices over the course of a century, supply would have to be cut to 1/8. That would be a more rapid rate of disappearance of material civilization than occurred under the Roman Empire's collapse. So I think on that grounds alone, we can rule out falling supply as a cause of a sustained significant increase in prices. And if you wanted to explain prices rising at 3, 5, 10% a year, well, obviously the problems are even more difficult. Then on top of that, there's further difficulties, and that is if we had prices rising because of less supply, there is a major symptom that people associate with inflation that it would be impossible to explain even if prices did rise on the foundation of falling supply. And that's the relationship between debtors and creditors. What happens to the relation between debtors and creditors in connection with inflation? What would you rather be? Would you rather be a stockholder who's a debtor or a bondholder who's a creditor in a period of inflation? A stockholder. Why? Well, if you're a bondholder, your wealth and income are contractually fixed. Meanwhile, prices are rising. The real value of your capital assets is declining. In contrast, if you're a stockholder, what do you expect will happen? You'd expect stock prices should be rising, profits should be higher. But if we seriously think about it, this important symptom, which also accompanies inflation, see, when people think of inflation, the leading idea they have is generally rising prices. But that is not the only idea. They also have a further idea that there is a systematic bias in favor of stocks versus bonds, in favor of being a debtor versus a creditor. Now, in order for that second criterion to be realized, that could not be achieved on the foundation of rising prices caused by falling supply. Just think, if what's raising prices is falling supply, okay, prices are higher, creditors are suffering, but what is present there to raise stock prices? What is present there to raise business profits? Is there anything present to raise sales revenues? See, we had the same volume of spending in the economy. It's just that there's less being sold for that same spending. What is the implication of that for business sales revenues? Well, that there's no rise. They'd be selling fewer goods at higher prices, but if we were selling half the goods at twice the prices, what's the sales revenue? The same. Well, do you think if business were faced with the same sales revenues, that would be an environment in which it would be easy to increase its profits? You wouldn't have the basis for higher profits. Would there be anything that would systematically operate to raise stock prices? No. So now, if you're a stockholder, you'd actually be no better off than a bondholder in those circumstances, because you too would have to buy at higher prices as a consumer, but you wouldn't have a higher monetary income, and you wouldn't have a greater value of assets. In fact, we could easily imagine conditions in which it would be worse to be a stockholder than a bondholder in such circumstances. Imagine that what brought about the reduction in supply were massive enemy bombing raids, and they wiped out factories all across the country and business assets. Okay, that will certainly produce a drop in production and supply and a rise in prices, but whose assets gets wiped out first in such circumstances? The stockholders. So the bondholders would have some protection. The stockholders are a buffer. The bondholders would certainly be worse off. They'd have to pay higher prices for whatever they bought, but the stockholders would be worse off even than the bondholders. They'd have to pay not only the same higher prices, but their assets would actually be reduced. Now, what explains the combination of rising prices and the systematic benefit to debtors' stockholders is insofar as the rise in prices is fueled by more money in spending. See, if what's causing it is more money in spending, what's going to be the effect of that on business sales revenues? They'll be up. And what's the effect of rising sales revenues on nominal profits? They're up. So this is how the income of the stockholders increases, and there's more money sloshing around to bid up stock prices. Now, you see, if we have a situation where prices double because there's twice the spending, and the extra spending is accruing to the benefit of the stockholders, we now have a situation where the total monetary value of the assets of business has doubled, but the value of the assets controlled by the creditors is unchanged. The whole gain is accruing to the debtors. Well, in this context, the debtors gain at the expense of the creditors, the stockholders at the expense of the bondholders. So if our view of inflation extends to more than rising prices, but to a further symptom of a systematic benefit of debtors and stockholders at the expense of bondholders and creditors, the only way to account for that combination is on the foundation of more money in spending. And there are further things that could be said, but I think this should show it. Now, let me try to further validate the quantity theory of money. I refer to the annexation by the quantity theory of the various cost push doctrines and the velocity doctrine. Most economists today are not solidly convinced of the quantity theory of money. Typically, it's treated as one possible explanation among a variety of explanations for generally rising prices. There's a significant body of economists who subscribe to the quantity theory of money, but I doubt that it's a majority, a substantial minority. And alternative doctrines come under the heading of cost push, and there are a variety of subcategories. Wage push. For many, many years it was popular to blame rising prices on the demands of labor unions. The labor unions force through wage increases. That raises business costs. They pass the higher costs along to the consumers as higher prices. That's one popular doctrine. Another equally popular doctrine was it's the greed of businessmen for profits. They raise their prices. And if their price is a price of steel or petroleum or whatever, that will constitute a cost to many other businesses, and so it could be subsumed under cost push. But if we seriously think about these doctrines, if it were the case that the increase in money and spending is really not essential, if that were not necessary, then let's consider what would be the effect of cost push in the absence of the increase in the quantity of money and volume of spending. Let's imagine we start off, we have an economy with full employment, and now labor unions demand a 10% across the board increase in wages. Okay, what's that going to do to costs and presumably prices? It should raise them on the order of 10%. Okay, now if prices are 1.1 times what they used to be, but we have only the same amount of spending to buy the output, what is implied about the quantity of output that people will be able to purchase? It'll be correspondingly less. It'll be 10/11ths. And what does that imply about the quantity of labor that will be demanded? That should be on the order of 10/11ths. So what has happened to the unemployment rate? It's now gone from 0 to 9+%. Now suppose the unions are not content to rest with a 10% increase, they come back for more. How much could the unions succeed in raising the wage and price level before they created a level of unemployment comparable to that of the Great Depression? 25%. So we'll have only 3 workers in 4 working. What would be output at that point? 3/4. What would be prices at that point? If the same money is spent to buy 3/4 the output, prices would be 4/3. And what would drive them to 4/3 would be wages of 4/3. Now, do you think that there is no limit to how much the unions will keep pushing as the unemployment rate keeps rising and more of their members are on the dole, and with each new rise they'll add to an already staggering rate? I would say wage push is going to burn itself out in fairly short order. Even if it took a super depression level of unemployment to accomplish it, I would say the maximum limit of something like wage push to raise prices is on the order of 1/3 as a total cumulative limit, and that's the end. And now, what if over the same period of years that the unions were serving to increase wages in the ratio of 4 to 3, suppose the average output per worker were improving because of scientific and technological progress, capital accumulation. So suppose that over this same period of time, the output per worker managed to double. So now at the end of this process, we have 3/4 the workers working, but each on average is producing twice as much as before. What would be the total output of the economy? What's 2 times 3/4? Well, 6/4, that's 3/2. So we'd have 3/2 the output, and if 3/2 the output had to be sold for the same total expenditure, what's implied about prices? And they would be 2/3. So in this context, if we combine both elements, the unions could, while they might succeed in raising wage rates to a certain degree and causing mass unemployment, if we allow for the rise in the productivity of labor, they could not possibly succeed in raising the general price level. They would succeed only in preventing it from falling as much as it otherwise would have. And that's the maximum cumulative limit of wage push. Now, what is necessary in order to keep wage push in being year after year as a significant phenomenon in which the unions might be getting year in and year out 5, 10, 15, 20% wage increases, and the process does not burn itself out in mounting unemployment? Well, it would have to be more money. Now, if it's more productivity, we've had more productivity in the example I gave you, it doubled. That didn't help. What's required is more money in spending. So if, when the unions get their initial wage boost of 10%, if over that same course of time, the quantity of money and volume of spending were increased such that there'd be 10% more spending, well, what quantity of goods can be sold at 10% higher prices if there's 10% more spending? Well, I would say the same quantity. We could sell 100 bottles of this stuff at $1.10 a bottle if people are in a position to pay $110. And then if that's the case, the unions have gotten wage increases, prices have gone up, but has it been accompanied by corresponding unemployment? No, it hasn't resulted in unemployment if the process is accompanied by an expanding quantity of money and volume of spending. And then the next year, the unions could do the same thing. And if again there's more money in spending, it can go on indefinitely. Well, what is obviously necessary for the process of wage push being a continuing significant phenomenon? More money in spending. So the point is that whatever limited tiny kernel of validity there might be to the doctrine of wage push, in order for it to have anything to do with a problem of inflation, it has to be subsumed, it's annexed by the quantity theory of money. Wage push can operate in the absence of an expanding quantity of money and volume of spending. And exactly the same thing applies to any alleged profit push. And here there's a typical confusion made. Suppose we think of the most plausible kind of case for profit push. Let's say a protected legal monopolist. He has the legal right to charge any price he wants. And if people are rioting, the National Guard will be called out to protect him. Okay, what kind of price would such a monopolist charge compared with conditions of free competition? Okay, he charged the highest price that would be profitable to him. Now, would he charge an infinite price? No, because monopoly, even a protected legal monopolist has to consider that as the price goes up, the quantity demanded does go down, and at some point the quantity demanded will go down to such an extent that he makes less at a higher price than at a lower price. Now, he might charge a very stiff, high price, but that would be it. Now, the question comes up, would he, having now set the price at this level, would he necessarily raise it the next year? So what would be necessary for him to raise this high price still higher in the next year? If nothing happened, if money and spending were the same, if the demand for his product, if the terms of trade-off were the same, that the same rise in price will cause the same fall off in quantity demanded, there'd be no basis for him raising his price. In order for him to find it profitable to raise his price as opposed to merely charging a high price, the conditions of demand have to change. The demand for his product has to go up. And in order to connect this with a problem of inflation, it's easy to see that what has to go up is the quantity of money and overall volume of spending. We can think of other things that might raise the demand for the monopolist product. Suppose elsewhere in the economy, certain prices fell. If production had gotten more efficient, so the price of bread is lower. The price of clothing has fallen. And now people have more money left over from such goods that they might potentially spend in buying the monopolist product. So that would raise the demand for his product. But what problem do we have in trying to present this as an explanation of a general rise in prices? Because the basis of it is falling prices elsewhere. Now, the demand for the monopolist product might go up because people change their preferences. They suddenly like his product more. But what does that imply about their spending for other products? That goes down. And what will be the effect of that on prices of other products? To put them under downward pressure. Now, if we want to explain how it is possible for this protected monopolist to be able to go on raising his price in conditions in which his higher prices are not the necessary accompaniment, are not necessarily accompanied by other lower prices, we need to have conditions in which the demand for his product can go up without there being any reduction in spending for other products. What does that imply about economy-wide aggregate spending? But it's higher. So in order, even for protected legal monopolists, to be able to raise their prices year after year and show up as part of any problem of inflation, the underlying phenomenon that has to be going on is the increase in money and spending. Now, let me just say a few words about velocity. You know, we can express total spending as the product of the quantity of money times the velocity, the average number of times the unit of money is spent in the way in which we're counting it. And many people like to argue, well, okay, more spending is essential, but how do we know it's really more money that's responsible and not just a rise in velocity? Now you can imagine a rise in velocity, but the real problem is that the main cause of the rise in velocity is the more rapid increase in the quantity of money. So you just think, as money increases more rapidly, what happens insofar as that begins to raise prices and create the prospect of prices continuing to rise? How does that affect the desire of people to own money balances? Where would you rather own money? In the United States, with the limited rise in prices that we have, or in some of the Latin American countries where you might expect prices to go up at double-digit rates in a single year? Obviously in the United States. So what does that imply about where you'd expect velocity to be higher or lower? If people would rather hold on to money here, velocity is going to be lower here. And where do you think velocity in reality is lower? Here. To the extent that countries have less inflation, their velocity is lower. And to the degree that inflation moderates, the velocity falls. Back in the 1970s, when inflation was proceeding much more rapidly than it is today, velocity was substantially higher than it is today. Under a gold standard, velocity would be substantially lower than it is under a fiat money standard. Now, there's more to explaining velocity than the expectation of rising prices. There are several other factors which work in the same way. For example, to the extent that new and additional money is introduced into the system through credit expansion, new money being created and then lent out in the loan market, what happens to the extent that this creates the expectation among businessmen that when they need funds, they can easily and profitably borrow the money? How will that affect their perception of their need to hold actual balances of money? They won't hold as much money. They'll figure it's more profitable to invest that money. We'll cover our future financial requirements through readily and profitably borrowing. So that serves to raise velocity. Now, what's the effect of more money in spending? We've seen that it raises business sales revenues. And what does an environment of rising spending and sales revenues do to the prospects for easily and profitably liquidating inventories? Where is it easier to profitably liquidate an inventory? In the face of rising sales revenues or stationary sales revenues? Rising. So what do you think happens to the extent to which businessmen will hold cash versus putting it in things like inventory? They'll put it more heavily into inventory. That serves to raise velocity. And then as one last important point, as more money and spending take place, the effect after some time is to raise nominal interest rates. Because it raises sales revenues, it raises nominal profits. The rise in nominal profits raises the demand for loanable funds. To the extent that business firms are themselves suppliers of loanable funds, if they can earn higher profits on their own funds, they'll only lend them at higher interest rates. So nominal interest rates go up. And as nominal interest rates go up, it becomes worthwhile to lend out smaller, shorter-term sums of money that it otherwise would not have been worthwhile to lend. At a 2% annual rate of interest, it would not pay to lend $100,000 for a period as short as a week, probably, because you'd only make $40 in interest. That's probably not enough to cover the bookkeeping costs. But at 5%, it might pay to lend such a sum. And to the extent that's a factor, that's raising velocity. So putting all this together, The only explanation of sustained, generally rising prices, plus especially the usual effects on debtors and creditors, the only explanation is rising spending, and the only explanation of rising spending is the increase in quantity of money. So the whole problem of inflation is necessarily one of an increase in the quantity of money. And on this basis, I think we're in a position to define inflation. A customary definition that you'll still find in many decent dictionaries is inflation is an undue increase in the quantity of money. An undue increase in the quantity of money. Now, that leaves open the question, what do we mean by undue? And here I think Murray Rothbard made a very major contribution to economics. He drew the line at undue at the point at which the increase in the quantity of money exceeds the increase in the supply of precious metals. So if we had the precious metals rising, let's say, at 1-2% a year, that's some increase in the quantity of money. It will contribute to some systematic rise in spending, some systematic elevation of profits, but it's very unlikely to raise prices because we should expect production and supply to be going up as fast, if not faster. And he would say inflation begins when the increase in the quantity of money surpasses that modest rate. An increase in the quantity of money more rapid than the increase in the supply of precious metals. And I think that's a very good definition. That's how I define inflation. But undue increase is a good second choice. Now, a definition of inflation equivalent to the increase in money more rapid than the precious metals, a definition is an increase in the quantity of money caused by the government. Because why does the quantity of money increase more rapidly than the precious metals? Is that a historical accident? If the government had never been involved in money, what would be our monetary unit? I think the precious metals. And it couldn't increase more rapidly. So the whole problem of inflation, about which presidents have repeatedly appointed commissions to study the phenomenon, there's a fairly easy answer which they could know if only they wanted to, and that's the increase in the quantity of money caused by the government. And of course there's a very obvious, simple solution that would once and for all put an end to any possibility of inflation, and that is the adoption of a gold standard. Now, once we think of inflation no longer in terms of a rise of merely rising prices, but the increase in the quantity of money, of which rising prices are only one leading symptom and need not appear immediately. You're going to have the increase in the quantity of money going on for a while, the inflation occurring. Maybe as that's initially occurring, it's taking place in the face of a higher demand for money for holding. And it may not show up in very much additional spending for a while. But the process of inflation is going on. Its leading symptom of rising prices has not yet appeared. Now we have diseases that work this way. Things start going wrong with someone, but it's not obvious. There's no detectable symptom. But it will occur. Now, if we're thinking that inflation is rising prices, if we accepted that usual definition, then when does the phenomenon of inflation come into existence? If we said that inflation is rising prices, then when does it come about? When prices rise. It doesn't exist prior to that moment. It's like cancer occurs when you're broken out with some big visible tumor, but not before that moment. And then if you think further of that definition, who is necessarily responsible for inflation if inflation is the rise in prices? Well, now think, if you go into who raises how do prices on shelves and in catalogs get raised? It's the capitalists. It's not the Keebler elves. It's whoever is giving instructions to the clerks, go out on the shelves, raise the prices, or we're coming out with a new catalog, our prices are higher. So it's thought that inflation springs into existence in the instant in which businessmen raise prices. No causation seen of any kind. And then what appears as the obvious, seemingly obvious remedy for inflation that wipes it out. Price controls. See, if we have price controls, then there's no inflation. And how many people think that? There are lots. But even if we have price controls, the inflation continues. It just doesn't manifest itself in rising prices. Now the inflation combines with the price controls to create shortages. We get different symptoms, but we still have the same phenomenon. See here, when we think of inflation in terms of the increase in money and spending, we're working with a causal element, and we're in a position to see an awful lot more. And now we're going to start seeing that. We're going to see that inflation is responsible not just for rising prices, but for many other very important consequences. Now, something you may have already heard me comment on, the government's ability to inflate leads to a total reversal of the relationship between the citizens and the government. If the government did not have the power to create money, if the money were chosen by the market, which would be gold and or silver, whatever money the government spent always goes back into the hands of the citizens. The government doesn't earn money, it simply spends money. And so whatever money it starts with inevitably gravitates into the pockets of the citizens. So where must the government turn to get fresh money? To the citizens. The government is financially dependent on the citizens. The government is not over and above them, supporting them. It is clearly supported by them. And anytime the government wants more money, it has to make greater exactions on the citizens. So anytime anyone is proposing new spending schemes, the citizens know that that means more money out of their pockets. Well, what do you think the popularity of new spending schemes would be if people knew that it meant immediate increases in taxes? It couldn't pass muster. And what do you think the effect of that on the whole size of government would be over the course of a generation or more? Suppose we had not had the government's power to create money. Suppose we had stuck with a gold monetary unit, and every dollar that the government wanted to spend, it had to turn to the taxpayers for it. The government would be an awful lot smaller. But now, when the government has the power to create money, it has money that it does not have to get from the taxpayers. It has its own independent money. And the great delusion can then exist that the government supports the people. The government is there spending, and everyone thinks, oh, what a wonderful government. It's my best customer. It's the source of all my funds. And everyone thinks they're beholden to the government, that we all are financially dependent on the government. Well, that's all the consequence of the kind of monetary system we have, and it brings about a vastly larger government. And that's of immense importance. So on the kind of monetary system that we have, whether it's fiat paper money that the government can create ad libitum or precious metals, that determines the whole character of the country, whether we're going to have a government which is the agent and servant of the people, or the people who are the wards of the government. Now, there are further consequences. The ability to create money makes possible the arbitrary redistribution of wealth and income in two main ways. First, from creditors to debtors, as in our discussion of stockholders and bondholders. Imagine you've bought bonds, and at the time there's a certain quantity of money. You've lent money. There's a certain buying power of money at that time. And now, by the time you're to be repaid, there's been a vast expansion in the quantity of money. The new and additional money, the extra sales revenues, the extra income has gone into the pockets of debtors and stockholders, not into your pocket, and it's also had the effect of sharply increasing the prices you must pay. So what's happened to your real wealth and income? It's gone down. What's happened to the real wealth and income of the stockholders and other debtors? It's gone up. So there's been this large-scale redistribution of wealth and income from creditors and bondholders to stockholders and debtors. And there's a further important aspect of redistribution that Mises was especially concerned to point out, that the increase in the quantity of money does not operate uniformly across the whole economy at the same time. It enters the economy at definite points. It raises the demand for some goods ahead of the demand for others, and then it gradually filters throughout the different parts of the economy. Some prices rise sooner than other prices. Now, if you get the new money right away, you're in a position to buy at prices which may not yet have risen, or only a few prices have risen. But if you get the money later on, well, meanwhile, you've gone through a considerable interval in which the prices you pay have gone up, but the income you're earning has not yet gone up. So there's this significant redistribution from people who get the new money later to those who've been able to get it earlier. Now, returning to the first point, the debtors and creditors, it is possible, if inflation takes place on a substantial scale, it has the potential to achieve a redistribution of wealth and income comparable to that accomplished by a massive violent revolution, comparable to what was achieved in the French or Russian revolutions. Just think of the German hyperinflation in the early 1920s. People who at one point were considerably wealthy, who had large investments in bonds and other fixed contracts, what they got was marks of no buying power. You can read stories. Someone got the proceeds of a life insurance policy, and by the time he got the proceeds of the life insurance policy, the postage stamp necessary to mail it was more valuable than the proceeds of the life insurance policy. So you have large numbers of people whose real wealth is absolutely wiped out, comparable to the government having passed a law saying, all of you people, we're seizing all of your wealth and property and turning it over to other people. That's what is involved. Now, there are further effects, the undermining of capital accumulation and thus real wages. Think about the fact many people, as recent events certainly prove, really don't have the talent for investing intelligently in the stock market. And the kind of investment vehicles that many people really require is something simple like putting money in a savings account, a life insurance endowment policy, some simple fixed contractual arrangement where they can count on getting some definite sum of money and they don't have to worry about day-to-day market fluctuations. Well, what does inflation do to the prospective purchasing power of such investments? Like, just think for a moment. Suppose today, most of you, I guess, are in your 20s or early 30s. Suppose you wanted to start making provision for the day when you'll be in your 60s or 70s, and you want to begin putting money aside. Well, suppose you start buying long-term United States Treasury securities, or AT&T bonds, or whatever. Now, you can count on the U.S. government securities, certainly, being paid to the penny in terms of the dollar amount. But imagine you bought a $1,000 30-year Treasury bond. What's going to be the buying power of $1 in 30 years? I think the only thing you could say with certainty is going to be less, a lot less. Now, while you don't have a risk in terms of the dollars that you'll get, you have an immense risk in terms of purchasing power. Because the purchasing power could be radically lower. It might be subway fares than $1,000. Now, what will determine what happens to the buying power of the dollar between now and 30 years from now? Well, we've already seen it depends on the rate of increase in the quantity of money, and who determines that? The federal government, in essence, the Federal Reserve Board, but not really just the Federal Reserve Board. There's also the Treasury. You know, the Federal Reserve Board is supposed to be independent and all, but they don't have true independence. For one thing, the legislation under which they operate could be changed, but also you have to realize that every member of the Federal Reserve Board has connections with other people. He didn't get to where he is totally by himself. He may have his old college roommate who's being considered as ambassador to some country or whatever. And if the Treasury would like a more rapid increase in the quantity of money, the word can be passed, why don't you visit your old college chum and show him the reasonableness of having a more rapid increase in the quantity of money. This is how things happen. And so what's really involved is there's a broad circle of high-ranking government officials, the advisors who influence them. Now, what knowledge must they have if they were to use any kind of restraint in the issuance of paper money? What would they have to know, first of all, if we have any prayer that they won't flood the country with money? Wouldn't they need to know the quantity theory of money? Now, how many of them do you think really do know it? Suppose we brought perhaps President Bush in for a mündliche Prüfung. I wouldn't be confident that the majority of these officials could give a good account of the quantity theory of money. Perhaps some of them could. But then let's assume that even if they could, how many of them could be relied upon to act on their knowledge in the face of circumstances which might tempt them to do otherwise, like not losing the next election? So if you think about the fact, if you invest in any kind of fixed income security, any kind of long-term fixed contract stated in paper money, what you are ultimately banking on is the knowledge and integrity of government officials and politicians.
Yeah, that's solid.
So that's really solid, right? Okay. So that's incredibly risky. And because it's so risky, the fixed income securities are no longer a reliable vehicle of saving. And this, I think, to the extent that people have become more or less aware of this, has served to significantly reduce the rate of personal saving. And to the extent that that has occurred, the ability to accumulate capital has been undercut. And as I've shown elsewhere, capital accumulation is the foundation of the productivity of labor. But then there is more, and one thing I wanted to be sure to show you, this comes under the heading of tax effects. A lot of people find this quite surprising. This is a table in my book, effective inflation on the nominal rate of profit and the taxation of profits. And what I'm assuming here is that we have, can you all see this in the back? Is this big enough? Should I enlarge it or try to? All right, we have a machine or any other form of fixed capital. We imagine it costs $1 million initially and lasts for 10 years. And then we want to see how things work without inflation. So we imagine the firm has sales revenues each year of $1 million. Its operating costs on account of labor, materials, fuel, things of that kind, we assume are $850,000. So its gross profit will be $150,000. If it follows straight line depreciation, it has a depreciation quota of $100,000. So its net profit before tax is then $50,000. If the income tax rate is 50%, it pays $25,000 in taxes. So its net profit after tax is $25,000. Now, since there's no inflation, there's no basis for assuming that there's a rise in the price of replacement assets. So there's no necessary reserve for replacement at higher prices. The whole $25,000 is available for consumption or expansion. The firm could pay a dividend of $10,000 and reinvest $15,000. It can genuinely expand its operations. Okay, now let's look at the same situation with inflation. We can assume that while this machine is still in use, before it's expired, sometime over the 10-year period, inflation has raised the sales revenues of this firm to $2 million and has also doubled its operating costs. So its gross profit is now doubled. But what's happened to its historical cost depreciation? That's unchanged. So what's happened to its net profit before tax? It looks tremendous. Quadrupled. It's quadrupled because the depreciation has not gone up. And what, of course, has happened to its tax? The same 50% tax rate means you pay $100,000 on $200,000. So they're paying higher taxes. Now they have a net profit after tax of $100,000. Well, there's one fly in the ointment. What should we expect the replacement price of that machine to be? $2 million instead of $1 million. And the firm will have only accumulated $1 million on the strength of its $100,000 depreciation quotas. If the firm would have any prayer of accumulating $2 million, what would they have to do with their whole profit? They'd have to set it aside as a reserve for replacement at higher prices. Well, what does that mean about the amount of money available for consumption or expansion? There is none. And if they pay a dividend of $10,000, and the stockholders will probably be demanding they do that, they're making more money than ever before, what is left for replacement? They'll be eating into their capital. So here we are, we have an incredible setup of delusion. Inflation makes business appear more profitable than ever before. But at the same, that's in nominal terms. But in real terms, there is impoverishment on the part of business. It's not able to replace its assets. And this went on in the United States through the 60s and then more so in the 70s. And I believe that this phenomenon can be related to something that many, many people have been aware of and have greatly lamented, but which I think this goes a long way to explain. Can anyone guess? Something that characterized a whole major swath of the United States. It's the opposite of the Sun Belt.
Oh, the Rust Belt.
The Rust Belt. Why was there a Rust Belt? What would explain the appearance of a Rust Belt? Well, wouldn't it be masses of companies incapable of replacing their assets?
Yeah.
And what would put them in that position? Well, the voracious demands to pay taxes, ignoring the fact that replacement prices of assets were rising. Now, what this amounts to, if we thought of profit, if we took a view of profit as beginning only after full replacement had been made for existing assets, what you'd need to allow for replacement if the machine is going to cost $2 million instead of $1 million, how much of a depreciation allowance would you need to accumulate $2 million in 10 years instead of just $1 million? $200,000 a year. Now, if we stated depreciation as $200,000, then our profit before tax would not be $200,000 but $100,000. And we'd pay a tax of only $50,000. We'd have a net profit after tax of $50,000. In those circumstances, we might have some prayer of replacing the assets. But if we think of the real income, if we think of the true profit after making full allowance for replacement, not as being $200,000, but only as $100,000, and the government is still collecting $100,000 in taxes, the government is taxing you on $200,000 of profit, not $100,000. What is the effective rate of tax on your real profit, on your profit adjusted for making possible replacement? Is it 50% or 100%? You have 100% tax rate, effective tax rate. And this is one of the consequences of inflation. Without any change in the tax rates on the books, merely by artificially inflating the profits subject to tax, inflation effectively sharply increases tax rates on profits. And interest, too, works in the same way. And that radically undercuts the ability of business even to replace, let alone expand. Yet the public perception is everybody is suffering, we're paying higher prices, we can't make ends meet, and these vicious fat cats are making profits hand over fist. This is an incredible racket.